So we are going to do section C. Section C contains two constructed response questions, each carrying 20 marks. So total 40 marks are there. And this is a area where we are going to score our maximum, right? So question 1 can be either consolidation or statement preparation, and question 2 will be a ratio interpretation, and this ratio interpretation can be either single entity ratio interpretation or cash flow interpretation or consolidated financial statement interpretation. So as I had already told you from the revision class, section C requires that remaining time. Okay, so I've just put 45 minutes. Actually section C is 20 marks, right? So 20 into 1.8. Section C, each question you should be doing in 36 minutes, but I guess 36 is too little. 40 is okay, or worst case 45. You cannot take anything more than 45. So I'm just trying to see if I can do section C, each question in 40 minutes. So I'm going to open my timer. In your exam, the timer will be there in your examination window itself. So I'm trying to do section C in 40 minutes. The first question in 40 minutes and the second question also in 40 minutes. So I'm starting. Okay, section C. It is consolidation. It is consolidation, and I guess there are two requirements, right? What is the first requirement? First requirement is to calculate the goodwill at the date of acquisition. First requirement is to calculate the goodwill at date of acquisition. Goodwill at date of acquisition. And we know how to calculate goodwill at date of acquisition, right? It is fair value of purchase consideration. Fair value of purchase consideration plus fair value of NCI at date of acquisition minus fair value of net assets at date of acquisition will get us goodwill at date of acquisition. Okay, and I guess in this question there are two purchase considerations. Okay, let us see. So that is the first requirement, to calculate the goodwill at date of acquisition. And the second requirement, what is requirement B? It is to prepare the consolidated SOPL, right? Consolidated SOPL for the year ended 30 September 2006. The second requirement is to prepare the requirement B is to prepare the consolidated SOPL for the year ended 30 September 2008. I guess there is something wrong. I'll write here itself. Consolidated SOPL for the year ended 30 September 2006. That is the second requirement. And this is the first requirement. Okay, so I'm going to read the question. On 1st January 2006, Laurel Company acquired 60% equity shares of Rakewood Company. Okay, so we know we need the workings. Working one is a group structure. I don't know why this is not shown fully. Maybe some technical issues, but it should have been shown fully. Should be shown fully. No need to do like this. Okay. So Laurel acquires Rakewood. Laurel acquires Rakewood. How much percentage? 60% belongs to parent, remaining 40% belongs to NCI, and the date of acquisition is very important. When is the date of acquisition? The date of acquisition is on 1st January 2006. The date of acquisition is on 1st January 2006. And the year end is, we know that it is there in the question. The year end is 30 September 2006. Year end is 30 September 2006. So the acquisition is for 9 months, right? The acquisition is for 9 months. The acquisition is for 9 months. From date of acquisition until date of reporting, there are 9 months. So on 1st January 2006, Laurel Company acquired 60% of the equity share capital of Rakewood in a share exchange in which Laurel Company issued 3 new shares for every 5 shares it acquired in Rakewood. So purchase consideration consists of share issue, and it is at 3:5. Let us see how much share capital do subsidiary have. The total number of share capital of subsidiary is 15,000. The total number of shares in subsidiary is 15,000. Into we are acquiring 60%, into the proportion in which we are giving, our parent company is giving parent company's share is 3:5, into parent company's share price is given here, it is 7. So the amount of purchase consideration paid through share issue is recorded. Additionally, on 31st December 2006, the date of acquisition is 1st January 2006. So they are talking about 31st December 2006. That is after 1 year. Laurel Company will pay to the shareholders of Rakewood $1.62 per acquired share. That is contingent consideration. Sorry, that is deferred consideration. We know deferred consideration should be recorded at present value. Deferred consideration should be recorded at present value. Again, total number of shares in subsidiary is 15,000. Total number of shares in subsidiary company is 15,000. Total number of shares in subsidiary is 15,000. Into we are acquiring 60%. Into for every shares acquired, we are planning to give 1.62. But after 1 year, and the cost of capital is 8%. The cost of capital is 8%. So divided by 1.08 raised to 1. Since it is after 1 year, raised to 1. If it is after 2, if the payment is made after, if we promise to make the payment after 2 years, it is raised to 2. Since it is 8%, 1.08. If it is 5%, 1.05. If it is 10%, 1.1. So deferred consideration is 13,500. Now we need fair value of NCI at date of acquisition, and we know in order to calculate NCI there is an equation. Total number of shares in subsidiary multiplied by NCI percentage multiplied by subsidiary company's share price. The subsidiary company's share price is given, it is 2. So we got NCI's value also. Then we require fair value of net assets at date of acquisition. So I'm going to calculate the net assets at date of acquisition. In order to calculate the goodwill, we know that while preparing the consolidated SOPL, there is no standard set of workings. But since we need the net assets at DOA, we are going to put a working for that, and we know that in net assets we will write share capital and retained earnings. Share capital we already know it is 15,000. So they are giving us the opening balance of equity. They are giving us the opening balance of equity. The opening retained earnings is 25,000. But we need the retained earnings at date of acquisition, and the date of acquisition is on 1st January 2006. So from 1st October 2005 to 1st January 2006, October, November, December, there are 3 months. So retained earnings at date of acquisition can be calculated as opening retained earnings 25,000 plus, opening retained earnings 25,000 plus 3 months profit. The total profit of the subsidiary company is 10,400. So you will add 3 months profit, 10,400 into 3 by 12. Then we will show any fair value gains. So let us see whether there is any fair value gain. At the date of acquisition, the carrying value of net assets of subsidiary company is equal to the carrying amount with the exception of a plant, which had a fair value of 4 million above its carrying amount. So we know that fair value gain for plant, there is a fair value gain. Fair value gain of plant is 4,000. Even though we don't need date of reporting column figure, right, because we are not preparing the consolidated SOFP, we are just preparing the DOA, but we know that there is a depreciation figure, depreciation, I'm just putting it here, 4,000 divided by the useful life is 2 years into 9 by 12, 1,500. We know that at the time of, we need that at the time of preparing the consolidated SOPL. Also, we are telling that inventory of 800 had a fair value of 1 million. So there is a fair value gain on inventory. Its carrying value was 800 but fair value of 1 million. So the fair value gain is 200. And all of these inventory had been sold by the year end. So by DOR, the inventory balance will become 0. By year end, the inventory balance is becoming 0. So this is how your working looks, right? We don't need the other date of reporting column because we are not preparing the consolidated SOFP. We don't need the PER. That is why we are not doing that. Now we just will just total this. We just need to get the net assets of subsidiary company at date of acquisition. The net assets of subsidiary company at date of acquisition is 46,800. 46,800. So the goodwill at date of acquisition is 16,500. Goodwill at date of acquisition is 16,500. So we got it. Now that part is done. We got 7 marks. Now we are going to prepare the consolidated SOPL. And we know that since Rakeput is our subsidiary, we can consolidate, but only for 9 months, because from date of acquisition until date of reporting there are only 9 months. So we are going to consolidate revenue, our figure fully plus subsidiary company 9 months. Cost of sales 58,200 plus 34,000 into 9 by 12. Gross profit equals revenue minus cost of sales. Distribution cost 2,000 plus 1,600 into 9 by 12. Admin expense 4,100 plus 2,800 into 9 by 12. Investment income, there is a note. Okay, we'll see 500 plus 400 into 9 by 12. Then finance costs 300. PBT is gross profit minus distribution cost minus admin expense plus investment income minus finance cost. Tax expense 4,800 plus 3,800 into 9 by 12. Profit for the year PBT minus tax expense. Okay. Now we know that there was a contingent consideration, so there will be finance cost. Sorry, there was a deferred consideration, so there will be a finance cost. The deferred consideration is already calculated at 13,500. So the finance cost will be 13,500 into, I guess the rate was 8%. I remember that. I should be remembering it at the time of exam. Into 9 months. It is 810 and I will record it under finance cost. Plus this figure. Okay. Then I had already calculated and kept that for the fair value gain of plant there is a depreciation of 1,500. So I'll add it to cost of sales. Then please listen here, okay? The inventory had a fair value gain of 200 at DOA, but by the year end it is becoming 0. So net asset is declining. If the net asset is declining, it is a loss. If the asset is declining, it is a loss. At date of acquisition, this inventory had a fair value of 200. By the year end, the inventory was entirely sold, so it becomes 0. And I told you, if there is a difference between DOA column and DOR column, it should be recorded in the SOPL. All the items which come either in DOA column or DOR column should be recorded in the consolidated SOPL, and those items which creates a difference between DOA and DOR is a profit or loss item, it should be recorded in the consolidated SOPL. So at DOA, the net assets of inventory had a fair value of 200. By the year end, it is becoming 0. So clearly the asset is decreasing, so it is a loss. It is a loss of 200. It is a loss of 200. And you should keep in mind that these two adjustments, the depreciation of 1,500 and the loss in inventory of 200 of the subsidiary company, these are the adjustments of subsidiary company. These are the adjustments of subsidiary company. It should be there in your mind. So those things are done. Now I am going to do the third point. Third point. It is something related to intra-group sale and URP. Laurel Company had traded with Rakewood for many years after acquisition. Sales from Rakewood Company to Laurel Company. So in this question, subsidiary is the seller. Subsidiary is the seller. Where consistently 1,200 per month. So intra-group sale is 1,200 into 9. And URP will be calculated on unsold goods. They are making a markup of 20%. And the unsold goods was 1,800. So URP will be 1,800. URP will be 1,800 into 20 divided by 120. It is 300. Intra-group sale will be removed from intra-group sale of 10,800 will be removed from both revenue as well as cost of sales. URP of 300 should be added to cost of sales. Then other adjustment, I guess they have an associate also. Okay, dividend received from subsidiary company should be cancelled. We know that dividend received from subsidiary company should be cancelled. Laurel Company's investment income, we know that Laurel Company has an investment income, and it includes its share of dividend of 500 paid by Rakewood. So Rakewood totally, subsidiary company totally paid a dividend of 500, out of which parent company will be getting 60%, right? So the dividend received from subsidiary company is 500 into 60%. This 300 is there in the investment income and it should be cancelled. Any dividend received from the subsidiary company, if it is there in the investment income, it should be cancelled. It should be cancelled. And Next thing is they also have an associate. They also have an associate. So Laurel's investment income consists of a dividend of 200 received from subsidiary, a dividend of 200 received from its subsidiary. This is its share of dividend of 500. So 500 is not the dividend received. 500 is not the dividend received by us. It is the total dividend paid by Rakewood. Our share is 60%, that is 300. Associate is paying some dividend, out of which we are getting 200. Now dividend from associate is 200. It is already there in our investment income. We cannot record it. We'll have to cancel. Any dividend received from associate as well as subsidiary company should be removed from the investment income. Should be removed from the investment income. And instead of that, an item known as share in profit from associate should be recorded. Share in profit from associate. And we are holding 25% for several years. It has been many years since we had acquired the associate, and this year the associate made a profit of 2,400. So share in profit from associate is 2,400 into 25%. That's it. I guess the adjustments are done. We had completed the SOPL, but the requirement is not done. Now this profit should be split between parent and NCI. This profit should be split between parent and NCI. NCIs we are going to calculate using working note 6. Parents is the balancing figure. The total profit which you are going to split is this figure. NCI's share of profit, and there is an equation. Subsidiary company SOPL profit, right, into time proportion will give you unadjusted profit. Then we are going to remove the adjustments. The adjustments are I guess there is a depreciation of 1,500, it will reduce the profit, and there is a loss in value of inventory of 200, it will also reduce the profit, and URP if subsidiary is a seller. These figures should be there in my mind, should be stored. It shouldn't be like I should be again looking at the question and seeing what are the adjustments of subsidiary company, right? Subsidiary company's SOPL profit is 10,400. Time proportion is 9/12. So adjusted profit is 10,400 into 9/12. Unadjusted profit is that much, and adjusted profit will be out of which NCI percentage is 40%. So NCI's share of profit will be 5,800 into 40%, 2320. So NCI's share of profit is 2320, and the remaining amount belongs to parent. That's it. So please keep this working too in your mind, okay? All the items which are recorded in DOR column will be shown in the SOFP, and any item which is recorded only in one column will also be shown in SOPL, and any item which creates a difference between DOA and DOR will also be shown in the SOPL. The difference will be shown in the SOPL. Clear? Assume here if it is 40, then inventory 200, it is becoming 40, so the difference is 160 loss. Since the asset value is decreasing, it is a loss. Okay, that's it. Okay, we did it in 30 minutes. So that is the power of consolidation. If consolidation is asked, normally it ought to be easy because we have been practicing lots of questions and we can do it very quickly, but don't make silly mistakes looking after the time. Okay, don't make any silly mistakes. You should be cautious in your approach.